Welcome back to the channel. While the mainstream financial media was entirely captivated by geopolitical headlines and whispers of a Middle East ceasefire this morning, three distinct, massive structural signals fired in the global silver market at the exact same time. Astoundingly, not a single major financial outlet connected these dots. First, the Shanghai Futures Exchange issued an unprecedented emergency halt on all silver futures trading. Second, the massive commodity exchange bank short position collapsed completely, falling to its absolute lowest level since the very beginning of the year 2025. Third, the spot price of physical silver exploded, reaching a staggering intraday high of $83.17 before the trading session was even halfway finished. This is an intraday range of $5.47. This is not a coincidence, and it is certainly not a routine market update. What we are witnessing is a profound convergence of structural data, technical positioning, and global supply chain fractures that is entirely unprecedented in modern financial history. We did not see this in 2011. We did not see this in 2025. This is a historic compression event. If you are currently holding physical silver, you are no longer just participating in a standard price rally. You are positioned squarely at the intersection of three independently confirmed structural signals that are systematically destroying the traditional paper pricing mechanisms. Let us establish the exact baseline numbers so we understand the terrifying magnitude of what is occurring beneath the surface. As of today, the silver spot bid sits aggressively at $81.32. The ask price is $81.57. We are up exactly $3.10 on the trading session, which represents a phenomenal, unignorable gain of 3.85%. Our intraday low plunged down to $77.70, proving definitively that this specific market is experiencing uniquely violent volatility. This is a market operating under acute, unrelenting structural stress, actively attempting to discover its true fundamental value. In real time while paper supply evaporates. Meanwhile, physical gold is trading at $4,856.10 on the bid. That is up an incredible $66.80 on the day, translating to a 1.39% daily gain. The intraday gold high actually reached $4,889.60. These exact numerical values mathematically confirm that the broader precious metals repricing event is not decelerating or taking a pause. Both monetary metals are moving with absolute terrifying urgency in the exact same direction on the exact same day. This is happening against a global backdrop that should, theoretically, suppress safe haven capital flows. The fact that both metals are surging anyway tells you that the relentless bid beneath this market is not driven by geopolitical fear alone. It is driven by raw, undeniable structural demand that literally has nowhere else to go. Before the recent conflict escalated, silver was comfortably trading above $96. The outbreak of war initially triggered a sharp, fear-driven correction, dropping the price back down. The mainstream narrative immediately pivoted to demand destruction and industrial slowdowns, but the correction did not deepen. Every single fundamental factor that originally drove silver to $120 in January was still entirely in place. The industrial demand did not cease. The war simply added volatility. It did not change the underlying architecture of the supply deficit. What we are witnessing today is the violent resumption of a structural trend that was merely interrupted by short-term fear. Let us look extremely closely at the first major signal emanating from the East, a signal that dictates the physical reality of the global market. On Thursday morning, the Shanghai Futures Exchange issued a shocking emergency notice that completely halted all silver futures trading across their active platforms. There is absolutely no reopening date announced to the public or institutional trading desks. You must understand that major industrial exchanges do not issue arbitrary trading halts when markets are functioning within normal, healthy parameters. These catastrophic circuit breakers are only triggered when the physical demand for a raw commodity completely overwhelms the available paper derivative supply. The exchange determined that normal trading could not continue without triggering an immediate, unrecoverable systemic breakdown of the exchange itself. The official Chinese silver vault holdings currently stand at exactly 23,300,000 ounces. While that number might seem impressive to the average retail investor, you must place it in its proper global macroeconomic context. China is the undisputed largest industrial consumer of physical silver. They require immense quantities for producing next-generation solar panels. They are also manufacturing high-performance electric vehicles and sustaining the critical, vast semiconductor infrastructure for the global AI technology economy. Measured against that unrelenting industrial consumption rate, 23 million ounces is not a strategic national reserve. It is merely a countdown timer. The Shanghai Futures Exchange just broadcasted that their stopwatch is running out faster than the paper market was prepared to acknowledge. When an exchange halts trading because it cannot source the underlying physical asset, the pricing illusion completely evaporates. The paper leverage system begins to fracture, forcing industrial consumers to panic buy whatever physical supply remains in the global pipeline. This panic occurs at absolutely any asking price as the world realizes the scarcity of the physical metal. Moving over to the Western financial hemisphere, we must carefully and rigorously analyze the commitment of traders' data recently released by the Commodity Futures Trading Commission. The net short position held by major swap dealers and immense institutional banks has been drastically and systematically reduced to approximately 23,000 contracts. This is a monumentally important metric because it represents the absolute lowest short exposure level we have witnessed since early 2025. That specific time frame was the exact period immediately preceding silver's historic face-ripping run to $120 in January. Let us do the basic, undeniable mathematics behind this positioning. 23,000 contracts multiplied by exactly 5,000 ounces per standard contract equals precisely 115 million ounces of total short exposure. Compare that diminished, shrinking number to the massive, record-breaking short positions these exact same financial institutions previously held just 1 year ago. For several decades, these specific massive entities historically acted as an impenetrable price ceiling, artificially capping natural rallies by relentlessly flooding the market. That dynamic is now officially dead. The major institutions are completely retreating from their highly leveraged bearish bets. Without that artificial paper ceiling, acting as a structural counterweight to suppress the price, the technical resistance levels are completely exposed to the upside. We recently broke through a major technical triangle pattern that formed between February and early April. In today's session, the price effortlessly pushed through $78, accelerated through $80, and sliced through $81 and $82. It maintained $80 as strong, unyielding support on the pullback. That is textbook continuation behavior. The next massive technical milestones sit dead ahead. The first major resistance zone is $95 to $100. Once that is breached, the zone after that is $115 to $120. Based entirely on the bank positioning data, the structural setup for violently clearing both of those high altitude zones is vastly more favorable right now. This setup is more favorable than it has been at any point in the past 14 months. The entities that built the largest short position in history were totally overrun in the last cycle, and now they possess less than half the ammunition they once held. We now arrive at the single most critical, systemic, and vastly underreported catalyst of this entire precious metals bull cycle, a catalyst ignored by Western media. The Chinese government has officially announced a total and complete ban on sulfuric acid exports, taking effect beginning next month. This strict, uncompromising embargo is currently projected to last through the entire remainder of the year, 2026. Why does an obscure chemical export ban matter for the spot price of precious monetary metals? You must understand the deep geological realities of mining. Approximately 75% of global silver supply does not actually come from primary dedicated silver mines. Instead, it is extracted merely as a natural byproduct of mining heavy base metals, primarily copper, lead, and zinc. Copper mining is the absolutely dominant source of this byproduct silver. Sulfuric acid is a mandatory, non-negotiable chemical input required for the hydrometallurgical processing of extracting copper from raw ore. Without this crucial chemical flowing steadily from China, copper production at these major operations will either grind to a complete halt or fall dramatically. When global copper production plummets due to chemical starvation, the byproduct silver simply vanishes from the supply chain completely. This disruption is hitting a supply chain that was already bleeding out. Chile recently reported production plummeting to a 9-year low. We are currently entering our 6th consecutive year of a massive structural supply deficit, with this year's shortfall projected to widen dramatically. Since 21, a staggering 762 million troy ounces have been completely drained and consumed from above-ground stocks. That is nearly an entire year of global mine production already wiped from the face of the earth. The supply chain fracture is no longer speculative. It is a mathematical certainty that will absolutely suffocate silver availability. Let us clearly establish the grim geopolitical and macroeconomic backdrop, because the headlines this morning were intentionally misleading. Iran publicly stated that the Strait of Hormuz is open, causing crude oil to briefly drop 11% and the Dow Jones to surge. Here is the actual reality that was buried on the front pages. The United States Navy actively stopped 13 cargo ships from passing. The blockade remains in full military force until a formal peace deal is officially signed. A ceasefire extension is simply being considered. The cascading consequences of this continued maritime blockade are tearing through industrial supply chains globally. Middle Eastern aluminum smelters have been forced to cut production. Aluminum prices in London just hit a 4-year high as a direct result. At least 19 different global jurisdictions have frantically imposed emergency export restrictions on energy, fertilizers, and agricultural products. 9 distinct Asian economies have implemented draconian policies to reduce national energy consumption. Europe is reportedly facing a catastrophic potential jet fuel shortage within exactly 6 weeks if the Strait situation does not dramatically resolve. These terrifying headlines represent the hostile operating environment in which physical silver is currently being priced. The Federal Reserve is trapped in a completely impossible mathematical position. John Williams acknowledged the conflict is crushing economic growth. This is the exact definition of stagflation. Stagflation is historically the absolute most hostile environment for traditional fixed income assets. The dollar index has already weakened approximately 2% since March 30th, falling down from near 99. The 10-year Treasury yield sits stranded at 4.29%. Real yields plunge into deeply negative territory. In a negative real yield environment, the old argument that silver does not pay a dividend becomes entirely irrelevant. The alternative is holding rapidly depreciating currency-denominated debt that actively destroys your purchasing power. Either the Federal Reserve cuts rates and accepts raging inflation, or they hold rates and accept a devastating recession. Both distinct paths are incredibly constructive for the ultimate repricing of silver. Now, let me walk you through what is undoubtedly the most structurally significant paradigm-shifting development of this entire financial cycle. It is a development that has received absolutely zero coverage in the mainstream precious metals community relative to its supreme importance. Highly classified, leaked documents from a United States and Mexico Critical Minerals Action Plan outline the active development of a brand new revolutionary paradigm for preferential trade. Within that specific governmental framework, rigid price floors supported by extensive additional measures are explicitly and legally described as part of the primary mechanism. Mexico is the absolute premier, world-leading silver-producing nation. Silver is explicitly named and highly categorized on the United States Critical Minerals List. This bilateral action plan document describes the deliberate establishment of mutual, sovereign supply chain resilience for critical minerals, firmly supported by government-backed price floors. Think very carefully about what this actually means for the global markets. If two massive sovereign governments establish a legal minimum price for silver, an absolute floor beneath which the market price literally cannot fall without immediately triggering massive government-level capital intervention, then the entire fundamental risk calculation for silver investors changes permanently. You're absolutely no longer holding a volatile, speculative commodity, dangerously exposed to unconstrained, limitless downside. You are actively holding a strategic national security asset with immense institutional price floor support being aggressively constructed by the absolute largest economy in the world working in perfect concert with the largest silver producer in the world. When this officially transitions from a working action plan to codified federal policy, the global silver market will violently reprice upward to reflect the total elimination of its lower tail risk. Let me provide you with the full, unfiltered range of what the most credible, historically accurate voices and largest banks in this market are now publishing. The research desks of major global banking institutions, equipped with strict compliance departments and massive reputational accountability, are all publishing base case numbers well above $100. Bank of America officially projects $135 to $139 for silver. Citigroup boldly projects $150 to $170. Capital Markets projects $150 to $160. TD Securities targets $118. CIBC is at $115. Deutsche Bank projects exactly $100. The most conservative target represents a massive 23% gain, while the most aggressive represents a staggering 109% gain. Furthermore, veteran independent analysts with multi-decade track records of calling absolute tops and bottoms are publishing numbers that sound almost unimaginable. Analysts like Michael Oliver and Jesse Colombo are explicitly pointing to the very real mathematical potential of $200 to $500 over this specific bull market. Another highly respected analyst has boldly published a roadmap for $20,000 gold and $800 silver based on a 45-year macro trend line. In the year 1980, that specific historical ratio reached an incredible extreme of 25 to 1. Today, the ratio sits vastly disconnected near 600 to 1. Historical precedent definitively proves that this precise ratio compresses violently and rapidly when massive structural conditions completely align, and those conditions are aligning right now. Commodity exchange inventories are currently sitting at an alarming 321 million ounces, drastically down from 531 million ounces. If you're looking at mining equities for leverage, understand this. Gold at $4,800 and silver at $81 creates unprecedented free cash flow. Mining stocks were hit hard when the geopolitical war began, ignoring underlying commodity strength. This disconnect has created the single clearest asymmetric investment opportunity available today. Two distinct sovereign governments are actively constructing a permanent price floor, The largest silver futures market in China just completely suspended trading on an emergency basis. The massive institutional banks have heavily reduced their naked short position to the lowest level in over a year. The vital chemical supply chain is being cut off. Not a single one of these massive events occurred simultaneously in 1980. None of them aligned in 2011. They are all relentlessly happening today. The date is Friday, April 17th, 2026. Investors who understand what is unfolding will not be measuring returns. They will be measuring generational wealth. Stack your physical metal with absolute conviction. Hold your strategic positions with unwavering patience. Don't forget to like, share, and subscribe the channel.